$200,000. That's exactly how much I put into the hottest high-yield ETF of 2025, the one promising 50, 60, even 70% monthly yields tied to MicroStrategy. 28 days later, it was down 50%, losses passed $100,000, distributions got slashed. Then slashed again, and again. Comments blew up, people laughing, people panicking, people threatening lawsuits. Right now, December 2025, the share price is sitting between $5 and $6, yields still look massive on paper, and thousands are asking the same question: is this thing dead, or the biggest second chance opportunity out there? Stay with me to the end. I'm showing you my exact dollar amounts today, the pivot that's turning every leftover distribution into automatic S&P 500 buys, the brutal truth no creator is saying out loud, and the one decision I just made about whether I'm adding more, or finally walking away. Let's jump in. Hey everyone, welcome back to the channel. Today we're diving deep into one of the biggest investing lessons I've learned the hard way in recent months. We're talking about high-yield covered call ETFs tied to volatile underlying assets, specifically those tracking a certain software company that's heavily invested in Bitcoin. For simplicity, we'll call this ETF MST. It's an enhanced income shares product that holds the underlying stock, writes covered calls on part of the portfolio, and uses a bit of leverage to boost returns. The promise: insanely high dividend yields, sometimes pushing 30–50% or more annually. The reality? When the underlying asset drops sharply, the ETF can lose 50% or more of its value in under a month, distributions get slashed repeatedly, and investors are left holding a position that's extremely difficult to recover from. A lot of people got pulled in by the hype. Videos everywhere showing massive monthly payouts, portfolios generating five-figure income, people talking about retiring early or replacing their salary with these distributions. It looked too good to be true, and in many cases, it was. The yields were real, but they came with risks that weren't always fully understood or communicated clearly. Leverage on top of an already leveraged underlying asset meant downside moves were amplified dramatically. When the crypto market pulled back, and the underlying stock corrected from all-time highs, these ETFs got crushed. I decided to put a significant amount of money, let's say over $200,000, into one of these products. Why? A few reasons. First, I wanted real experience to talk about. You can't credibly discuss something if you've never done it yourself. Second, the topic was exploding in popularity. Everyone was talking about it, showing huge yields, building entire portfolios around similar products. Third, I could afford the risk. This wasn't money I needed for bills or daily life. It was capital set aside for testing ideas and creating educational content. And honestly, part of it was curiosity mixed with a bit of chaos. Let's see what happens when you go big on something this hyped. The result? In about 28 days, the position was down roughly 50%. Distributions that started strong got cut, then cut again, then cut some more as the ETF fought to preserve its net asset value. Watching that kind of drawdown in real time is brutal, even when you know the risks going in. I made videos about it as it happened, one showing a $97,000 loss, another updating to over $100,000 down. The comments poured in, some laughing, some angry, some worried they'd done the same thing, others predicting the fund would shut down entirely. So how do I actually feel about it now? It's a mix. On one hand, it's the best-worst feeling. You learn so much from big mistakes. On the other, no one enjoys seeing that much capital evaporate quickly. But let's be clear. I went in eyes open. In my purchase video, I literally said this thing could drop hard, even joking it might go to $5 a share. I knew volatility was extreme because the underlying was tied to crypto, and I'd never had meaningful crypto exposure before. This was my entry point, and it taught me fast how differently crypto swings compared to traditional stocks. The big lesson here is the yield trap. When you see a product paying out 30%, 40%, even 50% yield, alarm bells should go off. Nothing sustainable produces those kinds of returns year after year without massive risk. These distributions often include return of capital, meaning you're getting some of your own money back dressed up as income. And when the underlying drops, the options premiums shrink, leverage works against you, and payouts collapse. It's not free money, it's compensation for taking on huge downside risk. My background is simple, boring index investing. broad market ETFs with long track records average 10% annual returns over decades. That's where the bulk of my serious capital lives. When I started exploring covered calls, the question was always, is this sustainable long-term? Everyone showing big numbers was reinvesting every distribution. If you're reinvesting everything just to keep up, why not own the growth version instead? The plain S&P 500 has crushed most alternatives over 20-30-year periods. These high-yield products have track records of months or a couple years at best. Not enough data to bet your future on. So, why do people flock to them? Psychology plays a huge role. Newer investors often haven't built the patience for delayed gratification. Waiting 20-30 years for compounding to work feels impossible when bills are due now. A product paying thousands monthly feels like winning. Like you've hacked the system. Getting that direct deposit hits different emotionally than watching a growth fund quietly compound. Plus, in uncertain times, job security worries, AI replacing roles, layoffs in tech. People crave stable monthly income. If your career feels shaky, the idea of a backup plan generating cash flow is incredibly appealing. But here's the truth. These aren't reliable income replacements for most people. The yields aren't stable. When markets correct, distributions plummet and NAV erodes. If you're counting on that money for rent or groceries and it gets cut 20, 30, 40%, you're in trouble. I've seen portfolios built almost entirely on these high-yield products, and while some have worked short-term, the risk of permanent capital loss is real. One sharp downturn and years of distributions can be wiped out. Back to my position. At purchase, the share price was higher. Now, it's hovering in the 6 or 7 range, with my average cost way above that. Distributions have dropped from over 50 cents per share monthly to 45 cents, likely heading lower. The fund is doing what it must to survive. Preserving capital by reducing payouts. Is shutdown a risk? It's the question keeping many up at night. If the price keeps falling to $2 to $3, operational issues arise. Reverse splits become likely, not fatal, but terrible optics, and often a sign of deep trouble. For me, the strategy shifted. Initially experimental, now it's about damage control. Selling everything would lock in massive losses. Dollar cost averaging down feels like throwing good money after bad when you already own too much of a volatile asset class. Instead, I'm treating remaining distributions as a feeder system. Whatever monthly payout comes in, currently around $9,000 but heading lower, gets immediately reinvested into boring broad market index funds. S&P 500 exposure, maybe some with modest covered calls yielding 10% for slightly enhanced income without insane risk. This pivot turns a disaster into a forced dollar-cost averaging plan into quality assets. The high-yield position becomes a source of cash flow to buy what actually works long-term. It's not ideal, recovery will be slow and capped due to the call writing, but it's responsible. If the underlying rebounds strongly, the calls limit upside. If it keeps dropping, more pain. But over 2 years, I expect somewhere between small loss and break-even, while distributions build positions in proven winners. Who's at fault when things go wrong? It's complicated. Product providers have compliance restrictions. They can't say everything without risking lawsuits. Marketing materials highlight yields but downplay tail risks. Some creators hype the income without enough warnings. But, ultimately, it's on the investor. You're an adult putting real money at risk. Do your own research gets said for a reason. Chasing yield without understanding leverage, option decay, NAV erosion, return of capital. That's dangerous. These products aren't scams. They do exactly what they say, generate high income by selling calls and using leverage. But they're tools, not core holdings. Best used sparingly, if at all, by people who truly understand and can withstand the swings. For income needs, far safer to build a massive growth portfolio first, then sell small percentages as needed in retirement. Modeling shows that often produces more spendable cash, with less risk. Covered calls, in general, still figuring them out. Modest versions on broad indexes, 8 to 13% yield, have outperformed in some periods, especially flat or mildly up markets. They reduce volatility, provide income. But, over full cycles including big bulls, they lag pure growth due to capped upside. The human element explains the appeal. Some hate the idea of selling shares later. They want to buy, hold forever, collect checks without decisions. Fair preference, but it comes at a cost. High-yield single-stock versions? Extremely speculative. Concentrated risk plus option capping plus leverage equals lottery ticket. Fine for small fun money if you can lose it all. Terrible for serious capital. My experiment proved you can't build a responsible portfolio starting with these as the foundation. Transitioning out is painful. Negative comments when losses hit? Expected. Internet loves schadenfreude. Some were funny, some mean, some genuinely concerned. The harsh ones often come from people who needed the reality check themselves. Seeing big losses scares them straight. For me, transparency was key. Showing the downside openly helps more than endless highlight reels. Leverage via loans or margin to buy these. Absolute madness. These products already embed leverage. Adding more personally is playing with fire. If it goes wrong, you don't just lose capital. You owe money. Debt aversion is personal, but owing during drawdowns destroys lives. Only use money you can afford to lose. Long term, this reinforced basics. Broad indexes, long horizons, consistent contributions. Emergency funds first, 6 months expenses minimum, tax-sheltered accounts maxed, then boring compounding, value opportunities when obvious. No need for complex products unless solving specific problems. This mess cost real money and time, but the education is priceless. It highlighted risks others can now avoid. If you're in similar positions, pivot where possible. Reinvest distributions wisely. Build foundations elsewhere. Don't chase yesterday's winners. Moving forward from the covered call disaster, the biggest shift is mindset. What started as content experimentation became a real-time case study in risk management. The position is still held. Selling now crystallizes losses without clear better alternatives. But every distribution is systematically redirected into stable, broad market exposure. This transforms a sinking ship into a cash flow machine feeding proven winners. Think about recovery math. Because calls are written, any underlying rebound gets partially sold off via premium collection. Upside capped while downside was fully felt. Compared to just owning the stock or Bitcoin directly, recovery will lag significantly. That's the trade-off accepted at purchase. Malkartor Shrila, Inte in Gangushim Intram for limited growth. When the trade goes against you hard, you're left with neither reliable income nor full participation in rebounds. This exposes why single stock high-yield covered calls are tools, not strategies. Useful perhaps for tiny portfolio slices if you love the underlying and want income now. Terrible as core holdings. Diversified moderate yield versions on indexes make more sense for income seekers. Lower, but sustainable, payouts. Broader protection. Why the explosion in popularity recently? Beyond psychology, timing mattered. Low interest rates for years pushed everyone toward yield. Then bull markets made covered calls shine. Underlying up, calls expire, worthless, full upside, plus premium. Distributions looked magical, but that's selection bias, good conditions only. Bear or volatile periods reveal truth. Current environment is different. Higher rates mean safer alternatives exist. Bonds, GICs, money market funds paying 4.5% with no principal risk. Why gamble on eroding NAV for higher but unstable yield? Opportunity cost is massive. For those living off distributions, rare in reality. Almost everyone successful with these reinvests everything. Portfolios grow via compounding distributions, not spending them. The few withdrawing tend to have massive capital bases or tax advantages abroad. For average investors, relying on variable high yields for expenses is gambling with necessities. Better path. Build huge growth portfolio first. Let it compound decades. In retirement, sell 3 to 4% annually as needed. Historically sustainable. Models show this often beats trying to live off covered call income alone, especially after taxes and erosion. Tax considerations huge too. In non-sheltered accounts, distributions taxed as income. High rates. Reinvesting after tax is inefficient. Growth funds defer tax until sale, often at lower capital gains rates. Another edge for boring approach. On fund issuers, they create demand-driven products. High-yield sells. Doubt many employees own their own aggressive funds personally. More likely they hold broad indexes themselves while selling yield to retail. Not hypocrisy, different risk profiles. Institutional money rarely uses these long-term. Reverse splits likely coming if price keeps dropping. Helps options chain, operations. Doesn't change economics but signals distress. AUM shrinks with NAV, inflows may slow. Survival possible via splits and cuts but recovery tough. Personal pivot details. Distributions now buy S&P 500 equivalents and moderate covered call index products yielding NAV 10%, trackable, boring, proven. Over time, this should rebuild elsewhere while original position hopefully stabilizes. 2-year horizon for assessment. Broader covered call thoughts after months studying. Moderate versions have place. Reduce volatility. Enhance income slightly. Good for conservative portions or specific goals, but never outperform growth long-term in strong bulls. That's by design. Human preference drives adoption more than pure math. Some prioritize simplicity, sleep well factor over maximum returns. High-yield frenzy feels like peak. Losses mounting, stories spreading, many rethinking allocations, smart ones diversifying into basics, others doubling down hoping for rebound. Classic trap. Beginners watching this. Don't start here. Build emergency fund first. 6 months expenses, liquid, safe. Then max tax-advantaged accounts with broad indexes. S&P 500 heavy if comfortable with concentration. 500 companies is plenty diverse. Add international, if desired. Contribute consistently regardless of price. All-time highs, best time to buy actually. Looking back, every previous high wished you'd bought more. Crashes temporary, growth permanent over decades. AI revolution, margin, expansion. Future likely brighter than past averages. Side income obsession key. Distributions nice but unreliable. Real security comes from skills, businesses, multiple streams. Upgrade earning power relentlessly. That's controllable. This experience eliminated strategies definitively. Full high-yield portfolios. Proven unsustainable publicly. Aggressive single stock concentration. Disaster potential too high. Leverage personally. Never. Remaining path. Hold original, feed distributions elsewhere, let time work, document journey transparently, hope it helps others avoid pitfalls or navigate, if already in. Investing simple but not easy, emotions derail most. Patience, discipline, basics win, everything else entertainment or speculation. Thanks for following the saga. More updates coming as things evolve. Full video script summary, linear narrative. The video chronicles a bold, transparent investing experiment that turned into one of the most dramatic financial cautionary tales of 2025, allocating over $200,000 into the Harvest MicroStrategy Enhanced High-Income Shares ETF, TSX, MSTE, a high-yield covered call product launched in March 2025 that holds MicroStrategy, MSTR stock, applies discerning 25% leverage, and rates covered calls on up to 50% of the portfolio to generate ultra-high monthly distributions, initially targeting 30-50% plus annualized yields. The investment was intentional, not a mistake, but a calculated risk for educational content creation. The creator, coming from a background of boring index fund investing, primarily S&P 500 equivalents like VOO, VFV, wanted to test the exploding hype around single-stock high-yield covered call ETFs. These products promised massive monthly income, with creators and communities building entire portfolios around them, touting retirement-level cash flow. Curiosity, chaos, and the ability to afford the risk drove the large allocation. Reality hit fast. Within roughly 28 days of purchase, the ETF plummeted over 50% as MicroStrategy, a leveraged Bitcoin play, corrected sharply amid crypto volatility. Unrealized losses quickly reached $97,000, then exceeded $100,000. Monthly distributions, starting strong, were repeatedly slashed, from over 0.55 share down to around 0.45 and lower, to preserve the fund's NAV. Viral update videos captured the pain in real time, sparking explosive engagement, mocking comments, schadenfreude, lawsuit speculation against Harvest, and genuine concern from viewers who had copied similar positions, core revelations from the experience. The yield trap, sky-high yields, often 30-70% plus, are unsustainable, frequently including return of capital, your own money returned as income. Leverage amplifies downsides dramatically in volatile underlyings like MSTR Bitcoin. Covered calls perform best in flat or mildly bullish markets but cap upside in strong rallies and get destroyed in downturns, especially concentrated leveraged single-stock versions. Most successful high-yield covered call portfolios rely on full reinvestment of distributions to grow. Virtually no one reliably lives off them long-term without eroding principal. Psychology fuels the appeal. In an era of job insecurity, AI disruptions and layoffs, immediate monthly cash flow, feels like a safety net trumping delayed compounding in growth funds. Investor versus issuer responsibility. Products comply with regulations but highlight yields over tail risks. Creators sometimes hype without strong warnings. Ultimately, adults must do their own research. Chasing yield blindly is dangerous. Crypto volatility lesson. Swings far exceed traditional stocks. Even prepared, the speed and depth caught the creator off guard until. Current status. As of mid-December 2025, MSTE trades around 530-544 CAD per share, down from highs near $19 to $20 earlier in the year, with AUMs 320-340. Distributions remain variable and reduced, but the fund survives. No shutdown, potential reverse split if it dips to 2-3. Yield appears optically massive, shopping 79% trailing in some calculations, due to depressed price, but much is return of capital. Pivot strategy. Position held. Selling locks, massive losses. DCA feels like chasing a falling knife. Remaining distributions, 9,000 month initially, now lower, are fully redirected into stable broad market indexes, S&P 500 equivalents, and modest yield covered call products. Percent yield. This turns the disaster into forced dollar cost averaging into proven long-term winners, aiming for break-even or small loss over 1 to 2 years while building elsewhere. Broader insights. Moderate covered calls, on diversified indexes, have a role for income vulnerability reduction, driven more by human preferences, no selling shares, steady checks, than pure math. High-yield single-stock versions are speculative tools, not core holdings. Worst of both worlds in downturns, full downside, capped recovery. Negative comments warranted as reality check. Transparency helps community learn. Debt margin leverage on these. Avoid already embedded risk. True path to wealth. Emergency fund. 6+ months. Max tax sheltered growth indexes. Consistent contributions. Skill. Upside income focus. The saga reinforces timeless basics. Patience, broad diversification and compounding in quality assets win long-term. High-yield hype is entertaining but often destructive. Ongoing updates track recovery, risk mitigation and whether the creator would ever repeat such aggression. Spoiler, no for core capital. This content is for educational entertainment purposes only, not advice. Always, DYOR.